Well, North American equity markets opened in positive territory this morning, even though we saw signs in both Canada and the U.S. of cooling economies. The Canadian economy, as we mentioned, shedding jobs last month. The U.S. economy adding fewer jobs than expected. But there is some math, folks. Remember that we were coming into this session after several losing days to begin August. We had seen bond yields rising. That was putting some pressure on equities. We did see bond yields decline after that U.S. jobs data, and so perhaps that opens the door for some equity activity. But I want to talk more broadly speaking about where we are in this equity rally of 2023. Samana joining us now, Senior Global Market Strategist at Wells Fargo Investment Institute. Great to have you back with us, Samir. And I guess my overarching question is, what should investors be thinking about right now?
Yeah, I mean, what we would say is the recent strength is really a mulligan, right? And that's basically a do-over. And the fact that we are back at, almost as all-time highs tells us that if investors weren't positioned properly for some of the weakness we saw late last year around economic concerns, this would be a time to kind of, redo some of that positioning. And so we would be moving up in market cap. We would be moving up in quality. We would be focusing on U.S. stocks. And the sectors we like are energy, materials, and healthcare.
Okay. Let's, before I get into some of that sector perspective, I know you shared with our producer a graph on what happens in interest rate hiking cycles and what specifically happens when you're getting closer to the end of rate hikes. Now, we're still not at a point where we can talk about rate cuts, I don't think, with, any I mean, we'll find out what happens, but what does history tell you about how the S&P 500 performs and how that's influencing your thoughts right now?
Sure. So I think we would say, we're late cycle, and what defines late cycle is a tight labor market, higher inflation, the Fed is raising interest rates. All those things tell us that there's probably an economic slowdown out ahead of us. And so the Fed, tackling inflation right now is focused more on maybe backward-looking data, right? Inflation is one of the most lagging indicators. So they're going to continue to hike rates because, as you saw this morning, wages are still much too hot for their comfort. And when you consider the fact that energy prices are starting to tick back up, you can easily see how that 3% inflation that we saw year over year, it might be the low for the year. And so if the Fed's going to continue to raise rates, what that tells me is that the economy, which is kind of going to feel the impacts of those higher rates, is going to slow late this year and early next year. And so what history tells us is after the Fed stops hiking, that's usually because the economy is starting to slow. And so the Fed's like, whoa, we're going to slow down a little bit. And then what happens is the economy actually does take a pretty hard kind of shift to the downside, and the Fed starts to cut rates. And so because the stock market is pretty coincident with the equity or with the economy, maybe a little bit leading, it's not going to bottom until the Fed's cutting rates because they're trying to get the economy kind of, firing on all cylinders again. So because of that sequencing, because the Fed is still raising rates, because the economic slowdown is out ahead of us, the equity market kind of eventual bottom is probably ahead of us.
So does that mean, and hopefully we can show the chart that we highlighted earlier once again for our audience, if on average history tells us that the S&P doesn't bottom until on average 6 months after the first Fed rate cut, we'll just pull out that chart from earlier. Are you saying that we could retest the lows from last year?
No, that's probably pretty unlikely. I mean, the last couple of years have kind of been defined by overshoots, and I think last fall was probably a little bit of an overshoot to the downside when the Fed was hiking rates by 50s and 75. I would also argue that currently we're in an overshoot to the upside, and so probably kind of the truth lies somewhere in between. We would say fair value for the S&P is somewhere around 4,000 to 4,200. That's our year-end target for 2023. So in our mind, could you maybe overshoot that a little bit to the downside, call it, 38, 3,900? We think that's very much still possible.
Okay, which potentially would see the S&P decline in the neighborhood of 500 points or so. Now, you mentioned that you're still gravitating towards, I believe you said, energy and materials, among others. What is it about those sectors that you like if you're concerned about a pullback in the broader market?
Absolutely. A couple of things. One, their valuations. Both sectors are already discounting recession to a large degree. And a lot of that has to do with weakness in China, as well as some of the recent weakness in commodity prices themselves. Now, that's before the most recent rebound. So we like the fact that the stocks are, already discounting a pretty big slowdown. And then I think the other thing, too, is we believe we're in a commodity bull super cycle. And a lot of that will be, kind of defined by really tight discipline on the part of producers. You can see that in what OPEC is doing. You can see that on the U.S. rig counts. Producers just don't believe that, commodity prices are going to be, going to the upside. So they're going to be very disciplined. And we think as demand comes back, as some of these economies, start to get going, especially outside the U.S., especially in China, we think that could drive another leg higher for commodity prices. We also like healthcare. It's a traditional defensive, and it's been shunned this year because people have gone towards higher growth, maybe, more, kind of attractive areas from a growth standpoint. But we think as growth becomes scarce, as the economy hits a recession, we think healthcare will come back into favor.